Well, welcome to our HighRock clients and any other listeners who have joined us this week, and thanks for taking the time to tune in to our weekly webinar where we're going to talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategy. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I've been battling a little cold this week, so please bear with me if for some reason my voice starts to go astray. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HighRock, and our financial planner, Bianca Tomlinson, is also on the call. We'll have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we certainly invite you to feel free to ask us questions. If you're a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we actually have an updated and separate introductory webinar that will provide you with this on our website under the About HighRock tab. Okay, as we do each week, let's quickly recap our themes for 2016 before we get started on what happened last week. Now, our overriding theme for 2016 is that financial markets will remain volatile. January saw a spike in that volatility, but markets have settled in late February, and so far in March, volatility has come down significantly thanks to the continued monetary stimulus by central banks. We're almost back to last October's lows with volatility. It's just somewhat eerie to see this much calm. We'll keep an eye on what happens next. Well, the big question remains whether or not the U.S. economy will continue to be able to grow while less positive global economic forces provide a drag. The consumer, as we saw a little bit more of today, is not, at the moment, providing a significant lift to the domestic economy despite improving employment growth, and there are other historically important indicators that have preceded recessions in the past that are starting to show disturbing trends, and we'll talk about that more in a moment. But this afternoon, Janet Yellen, the chairwoman of the Federal Reserve, was speaking, and certainly her words probably reflect the fact that the Fed is also seeing some disturbing signs. So we're going to keep, we'll talk about that a little bit more, but we're obviously keeping an eye on that very closely. Commodity prices, and especially oil, have stopped declining for the moment. Core inflation in North America has picked up a little, but not so much in other parts of the global economy. The European Central Bank increased its monetary stimulus. The Bank of Japan and People's Bank of China have done so as well. The Bank of Canada is on hold until they're able to analyze the impact of last week's budget. I'll talk about that in a bit. The U.S. Federal Reserve has pulled back from tightening for now, and the Bank of England also remains on hold. Geopolitical wildcards like the UK leaving the European Union, the Donald Trump factor, OPEC and oil-producing nations, China, North Korea, terrorist activity, and the refugee crisis are all increasing the levels of uncertainty. And we continue to watch bond markets for clues, but with some central banks forcing negative interest rates, that picture may be being distorted somewhat. Other credit markets, like high yield, are they telling us a different story? We'll keep chat about that a bit a little later on. And of course, as we say every week, we remain in a time of lower than average returns when after 6 years of above average returns, and as the cycle evolves, longer term returns are moving back to the average. Now, I should say that that means, in all intents and purposes, that as the cycle progresses, there is a future for better returns. So we're not going to be stuck in this low return environment forever. However, we will be moving forward. Now, I just realized I forgot to talk about how equity markets remain expensive, so I will go back to number 7. A little less so than last May, but earnings growth continues to decline and has so over the last 3 quarters, will probably decline in the first couple of quarters of 2016, and estimates for all of 2016 continue to be revised lower. Plenty has happened since our last webinar, although it's been a rather calm week. But let's get right to the financial markets because there's always lots going on there. In keeping with our key theme for 2016, it was a wild ride in January and part of February, but that has eased up recently. And as I mentioned before, the People's Bank of China, Bank of Japan, the European Central Bank, all adding further monetary stimulus. The U.S. Federal Reserve lowering expectations for higher rates. And now we're in a bit of a wait-and-see pattern. This is, as I would probably call it, the proverbial calm before the storm. We'll see. Volatility at the moment is now well below its long-term average. CNN's Fear and Greed Index missed that one this week, but we still are in overbought territory, and again, that gives us some cause for caution. Since our last webinar, our benchmark World Equity Index is unchanged and is pretty close to flat on the year. Last week it was also just a little positive, so not a lot of activity there. The best performer this week, Japan's Nikkei 225. The worst performer, Shanghai Composite in China. Now our strategy for 2016 to be overweight the Canadian equity market and underweight the U.S. equity market for rebalancing purposes continues to work in our favor. On a total return basis, which includes dividends and currency fluctuations, the TSX is up by 3.7%, while the S&P 500 in Canadian dollar terms is lower by about 4.1%, which is a difference of just a little under 8% in our favor. So that's good. The TSX has been the best performing country index in the developed world so far this year. Well, after hitting highs last May near 63, our benchmark World Equity Index made new lows near 49 in mid-January and then again in early February, which was about a 22% drop from the highs. Now then, it found some buying support from some short covering and a little bit of value investing after such a significant decline. Last week, buying failed to materialize to test the upper band of the downtrend channel, and the downtrend channel remains intact as we continue to see lower lows and lower highs. Now, until this pattern and the downtrend is broken, we should be on guard for further selling pressure, especially as markets are still close to overbought territory, although they've come down a little bit from the most overbought situation. The next test could well be to see where buying support would materialize. Now, this could take us to test the bottom of the channel in time, and also notice that trading volume has fallen considerably as markets rebounded from the lows. Without volume follow-through, this move ran out of momentum to the upside. Now, until we see positive developments and a change in that trend, we're sticking to our overweight cash thesis. Well, it was a positive week for quality fixed income as Canadian preferred shares were once again the best performer. U.S. high yield did not fare so well. Not much change to U.S. and Canada 10-year yield spreads this week, still hovering around that 60 basis point level. And oil fell this week. Oil found some selling pressure in the low 40s and will need to find buying support above $30 to continue its breakout of the downtrend channel. And the Bloomberg Commodity Index has turned lower, but still in the new uptrend channel. The Canadian dollar, after closely tracking oil prices as they fell, has now dislocated itself from that pattern. Steady rates from the Bank of Canada and increased deficit spending expectations from the government are the key new drivers. This will concern the Bank of Canada as it wants to see a lower Canadian dollar help drive export growth. There may now be some growing pressure on the Bank of Canada to lower interest rates. Well, our benchmark World Equity Index is comprised of about 52% of U.S. companies, So we keep a close eye on what is happening in the U.S. economy. The U.S. Federal Open Market Committee believes that the economy has been expanding at a moderate pace from their meeting last week or 2 weeks ago, but that's all historical information. They do expect this to continue, but with a big however, where global economic and financial developments continue to pose risks. And again, as I said, Janet Yellen was speaking again today about that. And as per usual, that interest rates will depend on incoming data. Well, in December, the committee members anticipated an average of 4 interest rate increases, which would equate to about a full percent in the overnight rate. But things have changed. As we suspected, they've modified this, and economic conditions certainly remain under pressure. It now appears likely that there might be only 2 increases this year. We'll go as far as suggesting that that could even be optimistic. The Fed's mandate is to foster maximum employment and price stability. Inflation is starting to move higher, but remains below the Fed's target at the moment. Meanwhile, the jobless claim trend continues to be sideways at the lower levels. This leading indicator of the state of U.S. employment at the moment remains strong. However, most of the growth thus far has been in lower paying jobs. Strong employment at the moment and rising inflation could prompt the Fed to want to raise rates. We'll see the latest data on the employment situation on Friday of this week. Despite improving labor conditions, consumer confidence has not been growing, and consumers have not necessarily followed through with spending as retail sales have not kept up. The consumer contributes approximately 2/3 to the U.S. economy. And industrial production, which contributes less than 20% to the U.S. economy, looks to have reversed course in February. And the GDP Now model, which forecasts the GDP growth for the first quarter of 2016, has dropped to 0.6% as of March 28th, which is down from last week where we saw it at 1.9 on this show. After yesterday's personal income and outlays release from the U.S. Bureau of Economic Analysis, the forecast for first quarter real consumer spending growth fell from 2.5% to 1.8%. So the forecast for the contribution of net exports for the first quarter of real GDP growth declined as well, following the report on international trade in goods from the U.S. Census Bureau. Well, it is expected and hoped for that the U.S. economy will contribute at least 20% to the global economic growth this year. One of our themes for 2016 asks, will that be enough? Well, we've discussed the relationship between high inventory to sales ratios and recessions in previous calls. As inventories rise and sales fall, companies have to reduce production and prices and earnings fall until those costs get cut. Well, last week we introduced another indicator of past recessions, the relationship between the ratio of coincident indicators to lagging indicators. Historically, this indicator has fallen in advance of a recession. It is certainly falling now, as you can see. Now, a leading indicator of economic activity would be data such as the average work week, jobless claims, new orders for goods, building permits, and stock prices. Coincident indicators, of which this graph partly is taken, of economic activity would be things like the non-farm payroll data, which we'll again see this Friday, industrial production, business sales, and then the lagging indicators include duration of employment data, inventory to sales ratio, credit and lending data, labor costs, and consumer prices. So when coincident economic indicators fall faster than those lagging indicators, it is a sign that the economic cycle is running out of steam. Now, historically, corporate profits have turned lower preceding a recession. Corporate earnings growth has been declining in the previous 3 quarters, as I said before, is now expected to fall in the first 2 quarters of 2016. Now, these 3 indicators that we've just talked about leave us more than a little concerned about where the U.S. economy is at this particular moment and what the future direction might be. Well, let's look at what's happening in the global economy. In general, there is, as I've suggested, an eerie calm that has settled over markets as we wait to see how the next round of economic data turns out. Well, Euro area companies represent about 16% of our benchmark world equity index. Back on March 10th, Mario Draghi, the head of the European Central Bank, donned his Super Mario outfit and surprised financial markets with a number of new monetary policy measures intended to assist economic growth and spur inflation. Financial markets are now waiting to see what, if any, economic indicators will show signs of improvement. Japanese companies represent 8% of the world equity index. In February, the Bank of Japan surprised financial markets with their first step into negative interest rates at last March's meeting. There was no change to monetary policy. Now, the Bank of Japan is hopeful that these measures will stir the Japanese economy, and financial markets are waiting to see the results. Companies in the UK represent 7% of the global equity index. At March's meeting, the Bank of England monetary policy voted unanimously to maintain the bank rate at 0.5%. Policymakers said inflation remains weak and noted that the uncertainty surrounding the referendum on UK membership of the European Union may delay spending decisions and depress growth. This week, we saw UK retail sales, and they slowed in February. As I said, Britons will vote on June 23rd whether or not to remain in the European Union. There are potentially significant economic implications for the UK as their participation in the Union is in question. Now, the Bank of England's Monetary Policy Committee issued a statement today saying that risks associated with domestic credit are no longer subdued, and global risks, which can also affect UK exposures indirectly, are heightened. The June 23rd referendum on the UK's membership of the EU is the source of the most significant near-term domestic risks to financial stability. The latest polls from March the 20th are showing that those who wish to remain in the Union hold a slight advantage. Uncertainty has pushed the pound lower, although it is now off its lows. Chinese companies represent 2.5% of the world equity index. In late February, an aggressively stimulative move, the People's Bank of China lowered the amount of deposits banks must hold in reserve by 0.5 percentage point. We're waiting on the next round of fresh data to see how the Chinese economy is responding. The next manufacturing data is due Thursday of this week. In Canada, where companies represent 3% of the world index, the latest budget will create a $30 billion deficit, but there were very few surprises for us. Canada's debt to GDP is the lowest in the G7, and obviously that's an important factor. We remain to see how the Bank of Canada will react and look forward to their next meeting in April to get a better handle on that. Okay, so what's coming on the horizon? Let's check in with what's going on with bond markets because they tend to lead other financial markets. Each week we look at these yield curves to assess what the bond market might be telling us. A positive sloping yield curve such as we see in the US, the UK, and Canada should give us some hope of better economic conditions in time as investors want to receive greater returns to protect themselves against future inflation. Negative yields below the red zero line indicate fear of deflation in the short term, where investors want the safety of government bonds for protection in Germany and in Japan. Well, if we look at the history of U.S. interest rates, the times when the 2-year in yellow, 10-year in green, and 30-year in purple yields are the widest apart reflects the most positive sloping yield curve. So that's when the economy apparently is performing at its best. Now, when the Fed raises interest rates because of their concerns for inflation, the 2-year yield rises. Much more quickly than the 10 and 30-year yields, which flattens the yield curve considerably, and typically a recession period follows. At the moment, the spreads between the three maturities remain relatively wide, but you can see why we focus on the U.S. Federal Reserve so closely, because usually when they start to tighten policy and raise interest rates, a recession is likely not too far away. Now, with all the other indicators pointing in recessionary directions, the Fed will definitely have to be very careful if they do not want to trigger another recession.
Hey Scott, it's Paul. Could I just add on this slide too, or back one, sorry. Yeah. That's part of the reason why we don't own any 2-year bonds in government of Canada or U.S. Treasuries, but we do own a fairly decent weight in 10-year and 30-year government bonds, because we don't think that yield will go up at all. And the prospect of a potential recession, those bonds would be protected pretty well and actually perform quite well.
Thanks, Paul. That's great commentary. So what are high yield bonds telling us this week? Well, historically they have led equity markets, and while the current gap remains to be closed and makes equity markets still look relatively expensive, the gap has narrowed a little as record inflows into the high yield market have narrowed the spread to equities. Canadian high yield, though, continues to lag U.S. high yield, even in the most recent rally. Now, a few weeks ago, Paul talked about the potential of increased defaults in the energy sector to impact the financial system in the longer term, and we're still closely watching developments there. Well, as for equity markets, when investors buy stocks, they buy a stream of future earnings. The price to earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price to earnings ratio is 14.2 times. Now, the 12-month forward-looking price to earnings ratio is currently at a relatively expensive 16.4. Last week it was actually a little higher at 16.5, but at the equity market highs back in May of 2015, it was 17.1. Pardon me. As a result of downward revisions to earnings estimates, the estimated year-over-year earnings decline for the first quarter of 2016 is a fairly significant minus 8.7%, which is below, well below the expected earnings growth of 0.3% as of December 31st. It would be the fourth consecutive quarter of negative earnings growth. Now, for all of 2016, analysts are projecting earnings increases of 2.4%. But just at the beginning of the year, analysts had actually projected 2016 earnings growth to be at a level of plus 7.4%. So when the green dotted line, the S&P 500 prices, reach the blue line, S&P 500 earnings, we can be more comfortable buying the S&P 500 companies. Until then, we are keeping our powder dry. Well, corporate profitability, the white line, tends to lead the S&P 500 with a bit of a lagged effect. We see no reason for it being different this time. In fact, it looks like an elastic band that's been stretched too far. The recent rally in stocks has pushed the enterprise value to earnings ratio, another metric that we like, back towards 13 times and well above the longer term average near 10.5. Now this has prompted us to take some sales to further lighten our exposure to expensive U.S. equities. We've maintained for almost a year now that stocks were expensive on the many different metrics that we monitor, and as we have shown you for the last couple of weeks, it is corporations buying back their own shares that's really telling the story of what's going on in equity markets. The white line shows the amount of corporate buybacks which are reaching levels that we haven't seen since 2007. Now, instead of paying out dividends or investing in capital expenditures for future growth, corporations have been buying back their own shares and driving share prices higher. This becomes self-serving to a degree, as chief executives are often compensated on their company's share price. The retail investor buying of mutual funds peaked in the final quarter of 2014, as shown by the bar graph of money flowing in and out of mutual funds. 2015 and the beginning of this year show significant outflows. When investors borrow to invest, it can drive stock prices higher. When they pay down their loans, they tend to sell, so margin debt data tends to provide an indication of equity market direction. Margin debt turned lower last May and lower again in January of this year, and that trend definitely inspires us to be cautious. And when the spread between large cap markets like the S&P 500 widen over the small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies and is considered unhealthy. When markets fell, that gap narrowed considerably, but that gap has widened as large cap markets have rallied more, while the broader Russell 2000 has lagged. This also inspires caution in us. So what does it all mean? Well, since last May, we have taken a cautious and defensive posture to investing, and in light of our key theme for 2016, we remain that way. We picked away at some value opportunities when they arise, but remain overweight cash until we see significantly better value in general. Well, central bankers and most economic forecasters are uncertain of the path of the global economy, and so are we. And as Paul suggested in a Globe and Mail article a number of weeks ago, we are somewhat worried about the prospect of deflation and its effect on capital markets. So our discipline, as we often refer to it, is at all times to protect our and our clients' capital, and especially so when we see the warning signs of potential problems. It is easy to be and stay fully invested at all times. That is why most advisors might recommend sitting tight on a fully invested strategy. Now, in many cases, as non-discretionary advisors are required to do, it is significantly more difficult and time-consuming for those advisors to adjust assets and positions one household at a time. That is why we use discretionary management, so that we can move all of our clients at the same time. We can be quicker, more efficient, and more impactful. Cash and cash equivalents have been and continue to be important defensive assets, so we are carrying greater than normal cash balances in our models. With equity market values having fallen so rapidly to begin 2016, we were able to find some opportunities to add reasonably cheap assets to client portfolios. But this does not change our defensive strategy. We are being patient and only adding small percentage weightings at a time, leaving lots of ammunition for future equity market weakness, and assets with better value if and when we should get it. If we don't, we can and will adjust our strategy accordingly and quickly. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, goals, risk tolerance, and time horizons. However, the ongoing research and analysis that we do at High Rock will dictate minor adjustments in short-term strategies that we make in our models, which we believe add value to the long-term performance. And that's how we justify our fees. Our High Rock models are built to incorporate the need for diversity and balance with fixed income, global equity, and a tactical equity with mid and small cap companies. Because our key theme for 2016 is focused on greater levels of volatility, the cash or cash equivalent component in clients' accounts, the underweight exposure to equity markets, and the overweight exposure to safe government bond markets helps to mitigate the impact of volatility on our portfolios. On an administrative note, it is almost the end of the first quarter of 2016. Quarterly reports will follow shortly. As is our policy, it is important to us to be able to sit down with you at least 2 times each year to have a detailed discussion of your current financial situation and to determine if we need to make any portfolio strategy adjustments. If there are any major changes in your circumstances, or if you have any questions or concerns you need to discuss, we are always available. So please do not hesitate to get in touch. Okay, well, what's up for next week? It's busy towards the end of this week. Tomorrow we see March business and consumer confidence in the euro area. As I said before, from China we're going to see their manufacturing and non-manufacturing indices on Thursday. In the UK we'll get a relook at what's going on, what happened in last year's GDP numbers. In the euro area we've got March inflation, a little bit of lag for Canada's January gross domestic product, and then we'll see the first quarter manufacturing data from Japan. Friday, euro area March manufacturing, and then in the U.S. we've got the employment situation report, which is always very widely watched, although we all must take it with a grain of salt because it is a number that is revised significantly month to month. And then we also have March manufacturing in the U.S. as well. Next week, a little quieter at the start of the week. We've got U.S. February factory and durable goods orders, and then February retail sales in the euro area. And of course, please don't forget the weekly HiRock webinar next Tuesday. Well, that's it for today's discussion. If anyone is listening might have a question, this is the time. All right, we've covered everything that everybody wants to talk about, which is great. However, if you do have questions and do wish to email us, we would be more than happy for you to send them. We would also love to get feedback on these webinars, what you like, what you don't, and if there's anything else you want to see us cover, we'd love to know about it. And as always, I want to thank you all for taking the time to tune in. Wishing you an excellent rest of the week and a great weekend, and don't forget to be back next Tuesday. Until then, this is Scott Tomlinson signing off.